Alrighty, next one up here. Tom Lee is bullish on small caps.
A nice bounce as well, with Bitcoin climbing nearly 6%.
Now, real quick here, if you haven't been keeping track of the Tom Lee small cap story so far this year, let's be very crystal clear about this. Tom Lee went into 2024 calling for like something like, he was talking about 50-60% rally in small cap stocks. If you were watching the reaction channel, earlier this year and at the end of the 2023, he was making these calls, right? And to be quite frank, the small cap stocks haven't done a dang thing until last week. Last week, we got a massive change in the market. What is that substantial change in the market? Well, there's a belief now in the market that folks know where rates are going, right? Everybody's kind of come to the assumption that the Fed's going to start lowering rates likely in September, or at the latest November, but likely September, right? And that's going to start the cut cycle officially. And so if they start a cut in September, we could get another one in November. We get another one maybe in January, something toward the beginning of the year, right? And boom, 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 you got the cut cycle going on, right? And outside of a complete massive recession, it will be like an orderly cut cycle. If there's a big recession, obviously they'll go to 1% or zero very, very quickly, right? So he made that call. Smalls hadn't done dang thing, but they're starting to do something. And so here he is on CNBC talking about small caps.
In Fundstrat, head of research, Tom Lee. Tom, always good to see you. So we've got to start with the big picture, including politics. Fortunately, former President Trump was not significantly injured in this assassination attempt over the weekend. But just talking about the impact on investments as well of this overall environment. If President Trump were to win, you say it would be positive for Bitcoin and for cyclicals and commercial REITs. But I'm curious, why negative energy and healthcare?
Thank you, John. I think the reason it's negative for energy is somewhat counterintuitive, but President Trump is favorable for drilling, and he'd want to expand where we look for oil, but that would put downside pressure on oil prices. So that's why we think it would actually ultimately be negative for energy stocks. And for healthcare, I think it has a lot to do with, potentially repealing Obamacare, but also just the fact that pharmaceutical companies and their pricing, I think, would come under a lot more scrutiny as well.
Okay. Now, I got to ask about your small cap call. I think you said a few months ago that small caps could rise 50%. We saw at the end of last week some interesting rotation into small caps. How much further in 24 can they run?
He better say a whole lot.
I think the rally that started last week for small caps is going to be larger than the October to December rally of last year. That was over 8 weeks, almost a 30% gain. The Russell 2000.
Okay, big call there. Small cap stocks can gain as much as 50% in 2024. Low June CPI gives green light for rally to continue. Rally could exceed last year's October through December 27% gain. Wow, big call, big call.
This time we have a larger short position by institutions. We have small caps even more oversold, and valuations, whether you look at median PE, which is now at 10 times 2025 earnings, even lower. So we think that this move could be something like 10 weeks and as much as 40%. So I think it is just starting. And a lot of it has to do with the fact that, the June CPI was so astonishingly soft. I think it's giving the green light for small caps to rally finally, because the Fed will, ultimately cut, hopefully by September.
And how much do you expect the S&P to potentially rise over that same 10 weeks?
That's a good question. I think July, our base case remains that July should be good for the S&P 500. So, something like 57, maybe even close to 5,800 in July. But I think that August is really going to be one where the rotation becomes more evident, and I think it's going to be a stronger small cap and maybe flat to slightly down for the S&P.
Okay, and so that's what I was getting at is how strong can the small cap, say the Russell 2000 as a proxy, be versus the S&P 500? And you're saying after July, you actually think that there's going to be a significant outperformance.
Originally I was thinking the Fed would start cutting when they had seen 2 straight months of CPI in the twos. So that could be anything in the twos, 2.9, 2.8, 2.7, whatever. I thought they would cut after that. But I will say it seems, kind of hearing their commentary, it seems like they're running out of patience. So it is very possible that they could cut still in the threes, which is interesting. It just seems like they're running out of patience. Now, there is still time between now and September for more CPI. Maybe we'd get something in the twos, so that's possible.
Small caps versus that index.
Yes, and that's kind of what happened in that October to December rally. That, as you know, the large caps actually really sputtered in late December and early January because of that rotation into small caps. And I think, again, because the positioning is even more short relative to large caps, that it could be an even more sizable move.
Yeah, so, I mean, I've been bullish on small caps for quite some time, so we've been waiting for these babies to really roll in a substantial way. But let's be very clear, they have started to make a move here, right? So if we pull up a 5-day on SoFi, 17% in the past 5 trading days. Honest is at double digits in the past 5 days. Revolve stocks at about 10% in the past 5 trading days, right? Cake is a little smaller gain there. That's like 2% in the past 5 trading days. And so, yeah, definitely a lot of these smaller cap stocks are doing tremendous. However, on the other side, you look at a lot of the big dogs, right? A lot of the big techs. Those ones are not doing quite as well. Where's my big tech list? There we are. Oh wow, Tesla lost a lot of gains. Tesla was up over 4% in the trading session, right? And lost some gains. So Nvidia's obviously down on a 5-day. Metastock's been hurt a lot in the past 5 days. That one's, geez, man, oh man, that's kind of vicious, right? Netflix, I don't think's done much in the last. Actually, I take that back. And by the way, Netflix does report earnings. I gave a rundown of earnings on the main channel yesterday. I gave a rundown of that. So yeah, they've been hit pretty hard there. MU, obviously massive memory chip play, down 2% in the past 5 days. Google McDougal, down over 2% in the past 5 trading days. Amazon, down 3.55% in the past 5 trading days. Mr. Softy's down. So you're looking at that, right? But then we go ahead and we pull up the Russell Wilson. And look at the Russell Wilson the past 5 days. Woo-wee! 7.6% in the past 5 trading days. You got to be flipping my flapjacks. But a year to date, pull up a year to date on the Russell, 8.66%. So like I told you guys, the Russell hadn't been doing a dang thing this whole year. And so Tom Lee's call just not looking very good, but now it has life. Let's be very crystal clear about that. It has life. Now, do I think the Russell can keep rolling? Do I think this momentum can last? As long as we don't have any earth-shaking recessionary type news, the Russell can keep rolling. But I will say, if at some point we get a real downspell in the economy, the Russell will start to falter again, and along with the other indexes as well, by the way. But we've got to see some real economic devastation out there for the market to take it serious. I'm talking unemployment rate all of a sudden go to 4.5, 4.7, 4.9%, and there's like a major big trend up as far as unemployment rising, right? I'm talking about credit card delinquencies getting far worse than where they're at right now. Right now, they're at a 10-year high, but with that being said, they're still like nothing compared to the great financial crisis or any time around then. We got to continue to see credit card delinquencies go up quite considerably. If we can get some of that stuff to play out, they'll freak a lot of people out about, the economy is going to crack here. And then all of a sudden, the cards come crumbling down, then the Russell will get hit. But, when do we get that? One question is, do we get that economic data that could really be devastating? That's a question. We'll see. The second question is, when do we get that data, if we got that data? Well, it's probably still several months away, right? Remember, all government data is backwards looking. So you might see something in the future that's 2 months old, 3 months old, 4 months old, right? And so that's just a little food for thought in regards to that. So it could still be quite a while. And in between that 4-month span or 6-month span or whatever, the Russell could roll 20, 30%, right? So something to just keep in mind. Hey, I want to thank you so much for watching that clip here today. I hope you really enjoyed that one. What you're looking at right now is 1000xstocks.com. 1000x does not just show you a billion different metrics that are completely irrelevant. It's curated, mandatory metrics, advanced metrics, curate it for long-term investors, not for traders, so you can understand a company on the highest level possible, how it operates, and most importantly, making judgments on whether you want to invest capital into a company or not. Understanding the upside, the downside with companies. Is that company worth our investments, or shall we keep our hands away? So how you can access 1000xstocks.com is you can go to the description area of this video, or you can go to 1000xstocks.com, apply for access to the service. There's a lot of opportunity away from mega cap
issue similar to the tech bubble. For technical analysis, let's bring in Ted Stone, technical strategist at Strategas Research Partners, a Baird company. Great to have you with us.
Thanks,
We've been
great to be
hearing
here.
for a long time about this durability issue that's too concentrated, and yet the march has gone on. And yesterday we saw glimmers of hope of some broadening
For the rest of the market.
For the rest of the market.
The Mag 7 as an index is 30% above its 200 moving average. That's pretty aggressive. It's not extreme like 2021 was, but it can create a summer speed bump, especially with the election cycle starting to kick out. You can get corrections during election years. So I wouldn't be surprised if you saw some profit taking, but ultimately, the key to this market is the equal weight S&P 500, because when you start to get these big weights, which are so influential now in the S&P 500, without the bench, as I like to call it, you're not going to be able to sustain that. And that's when real issues come through. And so I liked what yesterday had, where you had the large cap names pause, but really good internal strength.
We had, I think, 400 of the S&P 500 stocks actually trade higher today, which was a real positive sign.
Yeah.
When you take a look at some of the leadership when it comes to the AI trade, it has been semiconductors. And I think what was really notable in the month of June is we saw some really interesting moves, particularly among NVIDIA and Broadcom. We saw outside reversals June 20th or so that week. And they haven't really regained. They haven't gone up to back to highs at all set on those days. Should we be more concerned given the sort of the speed bumps exhibited by some of the components?
Yeah, I think the expectations are so high. We have earnings coming up that when you start to see outside reversals like that on very high volume too, like think about
very
this.
High volume, yeah.
The 2x leveraged NVIDIA ETF is one of the most traded ETFs now. That is very uncommon, right? Usually it's your SPYs, your IWMs, right? So it's really odd to see this single stock ETF up there. So I think that you're saying...
Why is that happening? It's not just because of excitement around NVIDIA. It's because fund managers are already trying to chase the market because they're likely getting destroyed by the S&P 500. And they're like, crap, we got to play catch up here. And so they're like, 2x leverage, NVIDIA.
Up for a correction. And if I was a portfolio manager, if I'm an investor, I have 10 stocks that are 40% of the S&P 500, 10 stocks that are 60% of large cap growth indices. So I want to look away. I want to look at healthcare. I want to look at financials, which as big tech has paused, those are the names that are actually starting to break out here too. So there's a lot of opportunity away from mega cap growth.
Mm-hmm. And going to some of the sectors that showed some glimmers of life yesterday, REITs had a very good day yesterday. Home builders had on this pullback in rates, the expectation that the Fed will actually start cutting decisively in September. Are those moves, do you think, sustainable? How do the charts look?
The REITs are really interesting to me, along with, a lot of those are in the small cap space. The small cap Russell 2000 has gone 670 trading days without
I was walking behind this a couple of weeks ago when I was in New York. I was thinking about, because they got security there, I was thinking about going in there and saying, hey, I'm Jeremy. Can I talk to Becky real quick? See if they let me in. I don't know. Maybe they would have. Maybe they wouldn't have. We'll see. They'll say, I got 4 silver play buttons. They're like, we don't know about silver play buttons, sir. Sorry.
That's the third longest streak in history, only following the tech bubble and the financial crisis. So the bar for stuff like real estate, healthcare, small caps in general to work, I think is really, really low, right? And tech has worked for good reason, but I like this idea of that broadening out, of looking away to the stuff that has not worked really in 2 years. The equal weight S&P 500, give or take a few days, has been basically sideways since January of 2022. So timeliness is there.
True.
And the sentiment environment, too, is really supportive, I think. It's nowhere near the euphoria we saw 3 years ago.
We were talking about Tesla just before we came to you. 11-session winning streak, I think it was at 40% or so in that, in this sort of run-up, most recent run-up that it's had. Is there any concern about the velocity of this move?
I wouldn't expect anything less from a Tesla type stock, right? The volatility there is immense. My issue with Tesla is it's the sloppiest of the Mag 7.
Yeah.
Right? Apple, NVIDIA,
Sure.
Google,
Fair.
Meta, those are all defined uptrends. Yes, they can correct some extended positions. Tesla's the hardest call because there is no trend there. You've had these volatile moves, 40% down, 40% up. I don't know if I have a great call there. I suspect the sentiment will get worse, right? It was pretty bad a few weeks ago. You still have about 13 or 14.
I don't know about sentiment getting worse. And, I'll just say in regards to Tesla, we'll finish out this. I'm not going to have time for this bank clip. I'm tight on time today, unfortunately. But in regards to Tesla, the options market got completely screwed up by the whole robo-taxi situation. And so is it anything that changes the future of the company? No. But there's no doubt it messes up the options market, which completely screws with the stock, which is why the stock's just all over the place recently here.
Ratings, that's the most of any stock, large cap stock out there. So yeah, low bar, but you're trendless. It's difficult to make a move on Tesla. I'd rather play through options.
And also in the category of making run-ups into earnings, banks. So what do you see in the charts there?
I like how the big banks have acted. JP Morgan's still strong. Citi and Bank of America have.
Let me just try to watch the first minute or two.
Citi kick off earnings today. All three topping expectations with second quarter beats. And next week, of course, Goldman, BlackRock, B of A, Morgan Stanley, Erica Najarian, and UBS large cap bank.
All beat, but going down, right? Well, why might that be? Well, I think there's two factors that aren't good here. One is if we could push into recession in the next year, it's not going to be good for banks. Secondly, if the Fed's about to go through a cut cycle, it's not good for those big banks. It's good for smaller guys, maybe a SoFi, maybe some of the regional banks, but I'm telling you, a cut cycle is not good for the big banks. The big banks have been making a fortune, those money center banks, because interest rates have been so high. And they don't pay out anything on savings accounts, right? So they've just been making a fortune. And the same could not be said for a lot of the smaller guys out there. So just a little food for thought. I wish I could react to that full video. I'm just tight on time. Guys, appreciate you joining me. Thanks so much for being here.